Welcome to the Deep Dive. Today we're taking your sources on CVR Energy's Q2 2025 earnings call. And we're going to extract the most important nuggets for your understanding.
Yeah, this was a really pivotal quarter for them, wasn't it?
Absolutely. Marked by a fascinating mix of operational transitions, some pretty complex regulatory challenges.
And significant leadership changes, too. A lot going on.
Our mission, as always, is to cut through the noise, give you that clear, insightful shortcut so you're well informed.
Exactly. It's a crucial moment, really, to look at how a key player in refining and fertilizers is adapting. It's a landscape that's, well, both challenging and, maybe promising in some ways. We're here to help you unpack all of it so you understand not just what happened, but why it matters.
Okay, let's jump right in. Maybe start with a snapshot of the results. Because CVR Energy's second quarter, it delivered a distinctly mixed financial picture.
Yeah, that's a good way to put it. Mixed.
The revenue actually exceeded analyst expectations.
Mm-hmm.
But the headline earnings per share completely missed the mark.
Big miss, yeah.
Which led to a pretty cautious market reaction, wouldn't you say?
Oh, definitely. It felt like a case of, accounting fog, maybe obscuring some operational clarity.
Okay, so what were the key numbers then?
Well, the company reported a consolidated GAAP net loss of $90 million. That translates to a loss of $1.14 per share.
$90 million loss on GAAP.
And even their adjusted EPS, excluding certain items, was still a loss, negative $0.23 per share. That fell well short of what analysts were expecting, which was closer to maybe negative 8 to 11 cents.
Okay, so a clear miss on the earnings side, but revenue.
Revenue was the interesting part. They pulled in $1.76 billion.
Which beat expectations.
It did, yeah. Beat expectations, even though it was down about 10% compared to last year.
And how about EBITDA? That often tells a different story.
Right. So GAAP EBITDA showed a loss of $24 million, but adjusted EBITDA, that came in positive, $99 million.
Okay, that's a pretty stark gap, isn't it, between GAAP and adjusted EBITDA?
It really is. And that divergence, it's critical. It was heavily influenced by an $89 million unfavorable mark-to-market adjustment. That was for the Renewable Fuel Standard, or RFS, obligations.
RFS. Always a factor there.
Always. So that massive non-cash adjustment plus, the reduced throughput from their planned turnaround, that really weighed down the headline numbers, created that accounting fog you mentioned earlier.
And the market reaction reflected that GAAP loss.
Well, absolutely. The stock took a hit, closed down over 5% on the call day.
Wow.
And there was even more weakness after hours. It's clear investors were focusing on those headline losses.
Maybe overlooking some of the underlying operational details, perhaps.
That's often what happens, isn't it? The initial shock of the headline number sometimes overshadows the nuance. So the key question for you listening is, what exactly created that gulf between a revenue beat and those big bottom line losses? Okay,
let's peel back the layers then. Unpack those pivotal financials, starting with that RFS effect you mentioned, the $89 million hit.
Yeah, that was, without a doubt, the dominant factor on the GAAP side. It's essentially an accounting estimate, right, of the future cost of these renewable identification numbers, or RINs.
Which they need to comply with federal biofuel mandates.
Exactly. And when those RIN prices swing, this estimate hits the income statement, even before cash changes hands. Creates huge volatility in reported earnings.
Right, so it's a non-cash adjustment, but it dramatically impacts the GAAP bottom line, and like we saw, investor perception.
Precisely. And what's really crucial to understand is the difference it makes to margins. The reported refining margin for the petroleum segment looked tiny, just $2.21 per barrel.
Ouch.
But the adjusted refining margin, which, tries to give a clear picture of operational performance, that was much more robust, $9.95 per barrel.
Okay. $2.21 versus $9.95. That's a huge difference.
It is. And it highlights the impact of those RIN expenses, about $3.93 per barrel, net of that mark-to-market, and also the timing of product sales around their Coffeyville turnaround.
So if we look past those RFS adjustments and the temporary turnaround effects, it sounds like the core refining business actually performed reasonably well. Implies a healthier underlying operation.
You're exactly right. It does suggest that. So let's dive into the segment performance now. Look at the strengths, weaknesses, resilience across the company.
Okay. Where do we start? Petroleum.
Yeah, let's start there. The petroleum segment, it posted an adjusted EBITDA of $38 million.
Okay. Positive adjusted EBITDA despite everything.
Right. Now, throughput in that segment averaged about 172,000 barrels per day. That was down from the prior year, but primarily because of that planned turnaround at the Coffeyville refinery.
And the good news there.
The good news is the turnaround was completed back in April 2025, and they said full operating rates resumed in July. So that sets the stage for, significantly higher throughputs in Q3.
That's key. And despite lower throughput in Q2, they actually saw stronger crack spreads. The Group 3 2-1-1.
Yeah, that's right. That's a key profitability metric for Midwest refiners. Measures the spread between crude and products like gasoline, diesel, and those spreads actually increased year over year.
Interesting. And operating costs.
Direct operating expenses per barrel decreased down to $6.45, mostly due to lower repair and maintenance costs during the quarter.
So some real operational positives there, even with the turnaround happening.
Definitely. Now, in contrast, the Renewables segment, that posted an adjusted EBITDA loss of $4 million.
Okay, so Renewables was a drag.
Yeah. Throughput was around 155,000 gallons per day. They processed about 14 million gallons of vegetable fuel oil at Wynwood. But this segment was clearly challenged. They had some unplanned downtime in May, the continued absence of the blender's tax credit, which is, a big incentive,
Right.
and also rising soybean oil prices, which is their main feedstock.
And they didn't recognize any production tax credits either.
True. Management said they're still waiting for final IRS regulations on that. So another headwind for now.
Okay, but there was a bright spot, wasn't there? The fertilizer segment.
Ah, yes. The nitrogen fertilizer segment, CVR Partners. That was a strong performer. Really strong.
How strong?
Generated $39 million in net income and $67 million in EBITDA, all on about $169 million in sales.
Wow, that's solid. What drove that?
Mostly higher sales pricing for UAN and ammonia and just robust demand overall.
And CVR Energy gets cash from that.
Yep. They received a $15 million proportionate cash distribution from CVR Partners during the quarter.
So that segment really provided some much-needed ballast against the volatility in refining.
It certainly did. A real stabilizer.
Okay, moving beyond the segments. Let's talk broader operational context.
Yeah.
Strategic outlook.
Right. So there's a clear turnaround cadence they outlined. No more additional turnarounds planned for refining in 2025 or 2026.
That's good news for utilization.
Exactly. The next one isn't expected until Wynwood in 2027. So it suggests a period of more stable, higher operating rates ahead for their refining assets.
And the Q3 guidance reflects that optimism, I assume.
It does. Petroleum throughputs are estimated higher, around 200 to 215,000 barrels per day.
Big jump from Q2's 172.
Definitely. Fertilizer ammonia utilization projected strong too, 93 to 98%. And renewables throughput guided at 16 to 20 million gallons.
Are they working on any future projects to boost things further?
Yeah, a couple of things. The Wynwood alkylation project, that's about 40% complete, expected online in 2027. That'll boost premium gasoline production. And they also have projects underway at Coffeyville to start producing jet fuel. So focusing on higher value products.
Okay, that leads us nicely into another big area, capital allocation and the leadership transition.
Right. On capital allocation, CVR Energy paid down a chunk of debt. They prepaid $70 million on their term loan in June, and then another $20 million in July. So that significantly cuts their principal balance down to about $235 million. Pretty aggressive debt reduction.
That's a clear signal, prioritizing balance sheet strength.
Absolutely. And consistent with that, no cash dividend was declared for Q2.
Yeah, they stopped that back in late 2024, didn't they?
They did. So they're maintaining that conservative stance. It's all about debt reduction, balance sheet flexibility right now. The stated goal is to reinstate a sustainable dividend later once things are, even stronger financially.
Makes sense. And then the really big news, the changing of the guard.
Yeah, huge news. CEO Dave Lamp announced his retirement effective December 31st, 2025.
End of an era there. Who's taking over?
Mark Pytosh is set to succeed him as CEO starting January 1st, 2026.
Okay, and there was a board change too.
Right. Brett Eichen was appointed to the board of directors on August 1st, 2025, so it all signals a, planned and managed leadership transition, not some abrupt or reactive shift.
Which usually provides more stability for investors,
Yeah.
right? Less uncertainty.
Typically.
Okay, so what does all this mean in the broader investor context? Let's talk about that regulatory labyrinth, the RFS and SREs, because this seems to be where a lot of the frustration for management comes from.
Oh, definitely. The Supreme Court recently confirmed the D.C. Circuit is the only place to challenge the EPA's 2022 SRE denials. SREs are small refinery exemptions.
Right, exemptions from the RFS obligations. And CVR has refineries that might qualify.
Exactly. And the EPA apparently intends to rule on the 2024 SRE applications before finalizing the 2026-2027 volume obligations. CVR Energy has already filed its 2025 SRE petition. They seem keen to test the EPA's 90-day statutory deadline for a decision.
So it's a critical legal and regulatory battleground for them.
Absolutely.
The management commentary. Dave Lamp, he was pretty direct, wasn't he?
Incredibly direct, yeah. He expressed some very pointed views, hoping for a more reasonable approach from the EPA. He specifically mentioned potentially under President Trump's leadership. He emphasized the role small refineries play.
And he made some controversial statements about the EPA's process.
He did. He said the EPA's reallocation of SRE volumes is, quote, made up and not mandated by law. That highlights a real point of contention. He even called their Wynwood refinery a poster child for an SRE, citing what he sees as disproportionate economic harm.
He's really not mincing words there. You can almost hear the frustration.
His comments definitely underscore how significant this RFS policy is for their refining economics. It's huge for them.
Okay, beyond the RFS frustrations, what was the general outlook from management for refining?
Lamp conveyed cautious optimism, near and medium-term outlook for refining. He pointed to improving market conditions, low refined product inventories, especially diesel.
Right, diesel has been tight.
Steady demand, and also a limited number of new refineries coming online globally at least until 2030.
And he mentioned diesel being backwardated.
Yeah, meaning current prices are higher than future prices. That indicates strong immediate demand, but it doesn't really incentivize building up inventories.
And what about the longer term, EVs and all that?
From a longer-term view, Lamp expressed a belief that the penetration of electric vehicles will slow down, reinforcing what he sees as the long-term need for fuels like gasoline and diesel. That's a significant viewpoint, kind of challenging some prevailing narratives.
Interesting. It raises a question, though, about CVR's own diversification, doesn't it?
It does. And Lamp actually addressed that. He reiterated a long-standing concern, the company's concentration, being heavily reliant on basically one market, one primary driver of the crack spread.
So what's the solution?
He expressed hopes for future M&A, either for CVR to acquire more diversified assets or maybe even for CVR itself to be acquired to broaden its market exposure.
That's a fascinating comment for an outgoing CEO to make.
It really is. Kind of lays out a strategic challenge for his successor.
Meanwhile, that fertilizer segment continues to be the steady performer.
Absolutely. Provides valuable stability, robust demand supported by geopolitics, increased corn acres. It's a natural hedge, really.
Confirms its value to the overall business.
Definitely.
But the renewable segment, still uncertain.
Very much so. Its future seems to hinge on clearer government policy, clearer credit support. Management basically indicated they're willing to participate, but they need more assurance before committing more capital.
So, kind of in a holding pattern there. Understandable, given the policy uncertainty?
Exactly.
Okay, let's loop back to that market divergence we talked about. And potential catalysts. Why did the stock drop so much, despite the revenue beat and the focus on adjusted margins?
It really seems the market fixated on that headline GAAP loss and, crucially, the persistent RFS exposure. That regulatory overhang is significant.
So for you, listening, what should we be watching going forward?
Key factors. Definitely RFS liability and RIN pricing trends, especially those upcoming SRE decisions.
Right.
Also, can they sustain those high run rates at Coffeyville and Wynwood now the turnaround is done? That's key for throughput.
And fertilizer pricing.
And nitrogen pricing dynamics, yeah. Keep an eye on that steady performer. These will be crucial indicators.
And what could potentially move the stock upwards? Potential catalysts.
Well, positive developments on the SRE front would be huge. If the EPA grants exemptions, even partial ones.
That would directly reduce their costs.
Immediately. Also, continued strength in crack spreads through the second half of the year. And, any broader shifts in RFS liability or policy could also move the needle positively. Those are the things to keep on your radar.
Okay, it is time for our Not Financial Advice segment. And remember, this is purely for entertainment, conceptual exploration. Like we're pitching ideas, not recommendations.
That's right. Always do your own research. Consult a professional.
So CVR Energy. It presents this fascinating mix, doesn't it? Operational recovery, that regulatory friction, the leadership change.
Yeah. On one hand, refining fundamentals, maybe some long-term strength. On the other, RFS is just the significant, unpredictable cost.
Okay, so here's trade idea number one, the SRE redemption call.
Ooh, okay. What's the play?
The play. Consider a long position in CVI equity, maybe combined with selling some out-of-the-money put options, perhaps a put spread for protection. With an expiry shortly after the EPA's anticipated ruling on those 2024 SREs, management hinted that might be before the 2026-27 RVOs are finalized.
Okay, and the rationale behind that, betting on SRE relief.
Exactly. Management is clearly agitated. Lamp called Wynwood a poster child for an SRE, hinted at legal action. If the EPA does grant SREs, even partially, it could provide a huge immediate boost to refining profitability by cutting those RIN costs.
Right.
So this trade tries to capture that potential upside while maybe managing the risk of denial with the option structure.
And the outrageous but plausible part.
It's betting on the EPA to actually change course, despite history, based on management's hope out of the current administration and their legal arguments. It's a contrarian bet on regulatory relief.
Got it. Okay, trade idea number two.
Trade idea number two, the diversification divestment arbitrage.
Arbitrage. How does that work?
This is more of a longer-term pair trade. Short CVR Energy, CVI equity, and go long shares of CVR Partners, UAN, its fertilizer subsidiary. Or maybe a comparable pure-play nitrogen fertilizer producer.
Okay, short the parent, long the fertilizer sub. Why?
The rationale goes back to Lamp's comments. He explicitly said CVR's biggest issue is being in one single market with one single driver, the crack spread.
And he hoped for M&A to diversify.
Exactly. Meanwhile, the fertilizer segment is the stable ballast with strong fundamentals.
So the wild element here.
He's anticipating a potential strategic move under the new CEO, Mark Pytosh. Maybe a spin-off or divestiture of that highly profitable fertilizer business. That could unlock value for shareholders directly in the fertilizer segment while potentially hedging against the refining segment's ongoing RFS struggles.
So you capture the fertilizer value directly while betting against the refining headwinds.
Right. And the plausible aspect comes from Lamp's own stated desire for diversification and the, inherent clear value of those fertilizer assets. Maybe they'd be better appreciated standalone.
Interesting pair trade concept, separating the parts.
Okay, so just to recap then, CVR Energy's Q2 was really a quarter of navigating substantial RFS headwinds. Big operational transitions.
Yeah, and while the market reacted cautiously to that earnings miss, management did articulate, a longer-term optimism for refining and definitely a disciplined approach to the balance sheet and that leadership continuity.
So for you listening, you'll definitely want to keep a close eye on the EPA's SRE decisions. That's probably number one.
Absolutely. And the company's ability to maintain those high utilization rates post-turnaround, plus the broader trends, crack spreads, RIN prices, critical indicators for the coming quarters.
So as we wrap up your deep dive into CVR Energy, given everything we've unpacked, what are your key takeaways on their strategic path? Is the market missing something fundamental here, or is that regulatory risk just too high right now? Something to think about.
And just that final reminder, of course, this discussion is purely for informational purposes. It does not constitute financial advice.
Always do your own research. Consult with a financial professional before making any investment decisions.
Absolutely.
Thank you for joining us on the deep dive. We hope this exploration of CVR Energy's Q2 has given you a clearer, more nuanced understanding.